Let's discuss some general principles of taxation. So first of all, there's three types of income that you can have. There's earned income, there's portfolio income, and lastly, you have passive income. Passive income, which mainly applies to limited partnerships and rental real estate, you can only use the losses to offset them against passive income. You can't move between various buckets. But when you're talking about capital losses, you can use them to offset up to $3,000 of ordinary income per year, and that would roll over to the following year. So the way that it works is you basically add your gains and losses in terms of your capital gains and losses. And if you end up with a negative number, you can offset basically $3,000 of ordinary income, which would be like earned income. Earned income is essentially anything that you actually work for. So, for example, if you want to contribute to an IRA or a Roth IRA, you have to have earned income. It means you have to work for the income. You can't just receive it passively by sitting at home and collecting dividends or the proceeds of a limited partnership, right? So you would essentially total your if you end up with capital losses, you can take $3,000 of that and offset it against $3,000 of your earned income. And then the remainder would fall through to the following year. Now, if you have some possible gains, right? Ideally, hopefully you have some portfolio gains, like some long-term capital gains. You can use those losses, those old losses, to offset it against your long-term, some of your gains, your long-term or short-term capital gains. And then hopefully you end up in the positive next year. But then if you're in the negative again, if you have another $3,000 left, you can offset again $3,000 against your ordinary income. And that could just keep going on and on and on and on and on. And just to reiterate, if it's passive income passive losses can go against passive income. And certain LPs, you can have beneficial losses that you can offset. Like, for example, if you're dealing with oil and gas, you can offset, like you can write off intangible drilling costs, which are basically costs that cannot be recouped, cannot be resold. So tangible drilling costs would be like actual equipment that you could resell. Intangible would be fuel, employee salaries, prepping the ground with chemicals, geological surveys, stuff like that. So there's a lot of interesting stuff with limited partnerships. With real estate limited partnerships, you can have regular straight line depreciation. You could depreciate the asset. Same thing with any kind of like equipment. And then you could do accelerated depreciation if you want to do it faster, but then there's a depreciation recapture element. Also, if you're dealing with nature-made materials like timber, lumber, oil from the ground, you can actually deplete that. Because once that oil is gone, it's not really coming back, at least in the near future. So you have depreciation, depletion. One thing that you can't actually depreciate or deplete is like raw land. Like raw land cannot be depreciated. So there are some interesting, limited partnerships with raw land, but obviously they're quite dangerous because raw land, if you're not doing anything on it, you're just hoping that the land goes up in value. So hope that makes sense. Please enjoy the rest of your day. Like and subscribe for more information. Thanks.